And let's get to today's market action with our market panel, Charlie Bobrinskoy of Ariel Investments and Adam Crisafulli of Vital Knowledge. It's good to have both of you on. Charlie, I'm going to start with you here because we saw bond yields come off a little bit here. We saw stocks basically middling, at least into the close. But commodities have, in general, maybe ex-oil today, have been pretty strong as well. What to make of some of these different cross currents and dynamics, and where do we go from here?
Well, in general, lower interest rates are better for some commodities, particularly gold. I think there is a sense that if we got a little bit of interest rate relief, we'd get a little bit of stronger economy, particularly in housing. That's good for copper prices. That's good for demand for oil. A better economy would be good for China, which obviously is a big consumer of commodities. And fundamentally, I think there is a sense that maybe people don't want to have all their money in the stock market, and having in some hard assets like timber and Iowa farmland and gold is not a bad place to be. You know, the stocks haven't done as well as the underlying commodities. The underlying commodities have been very strong. The stocks haven't really kept up. So we do think there's some opportunities there.
Interesting. We don't talk about timber very much. So I'm going to dig back into that with you in just a moment. But first, Adam, I mean, we've got a crock pot of considerations for investors as we do await inflation data and bank earnings later this week. You got firmer U.S. growth backdrop. You got hawkish repricing of the Fed pivot expectations. Higher commodity prices, we just talked about, higher break-evens, higher sell-side S&P 500 price targets, increased downside hedging, breadth improvement, and potentially some reflationary leanings. That's just the list I'm working off of. What to make of it?
Yeah, there's a lot of moving pieces, like you just said. I think it's interesting if you kind of read the tea leaves over the last several weeks. You do have a lot of potential tailwinds on the industrial, on the manufacturing front. So you've had a string of positive economic numbers out of China. You've seen the price action in commodities with oil and gold and copper. The USIS manufacturing ISM was decent as well. And then on the flip side, you've seen a number of negative data points with regards to the consumer and retail spending. And so potentially there's a bifurcation happening. And it'll be really interesting to see within the CPI tomorrow if you really start to see a weakening in services inflation and shelter inflation, because it's incumbent on those two categories to start to move lower if the CPI and the PCE are really going to make that final move down to the Fed's target. So you are at this possible inflection point in the overall economy. So it'll be interesting to kind of see how this all plays out, not only with the CPI tomorrow, but we're right on we're right ahead of earnings season. The banks Friday morning are going to give us great insight into just the state of the economy, especially with regards to consumer. There's been a few storm clouds around consumer credit quality, especially at the low end of the consumer. So it'll be really interesting to kind of hear their perspective on how things are shaping up there.
Charlie, what matters more, inflation data or earnings data, especially as we are talking about diversification into real assets?
Yeah, I'm going to go with inflation data because the Fed just is stubbornly refusing to reduce rates to where they should be until they see a number that they're happy with. Just a very important data point on this is that Gene Fama at the University of Chicago came out with a study probably 40 years ago showing that the real rate of interest for the risk-free rate should be about 1%, and it had been for 100 years. And that means that with 3% inflation, we should have a 4% short-term one-year Treasury rate. We've now got an over 5% rate. So unless you think we're going back to 4% inflation, which nobody does, interest rates are too high. When they come down, which I think they will this year, it's going to be a real boost to housing stocks, to the ability of consumers to pay off their credit card debt, to finance their lives. So I put me down for interest rates being the number one driver.
Okay. Adam, do you see it the same way, especially since we do have a week that has a lot of Treasury supply hitting the market, and we do have, as you mentioned, CPI, and as Steve Leisman is arguing, PPI, which arguably is going to matter more to PCE?
Yeah, no, these are going to be crucial data points. You've already had a pretty aggressive hawkish repricing in Fed expectations and yields. So I think your risk reward is to the dovish side into the inflation figures, meaning that, I think it's going to be easier for the CPI to come up looking less hawkish than feared versus the alternative. And with regards to the Fed, keep in mind that there's a bifurcation happening among international central banks. So we have the Bank of Canada tomorrow and the ECB on Thursday, and both those central banks are going to have dovish forward guidance. You've had some pretty downbeat economic numbers out of both regions, and that's going to provide justification for their central banks to commence rate cuts in June. So that's going to be something to watch also this week. especially the ECB on Thursday, which should have a relatively dovish forward guidance for their June meeting.